Welcome back to Financial Market Insights for Traders, the podcast where we break down complex financial topics to help you navigate the markets with confidence. I'm your host, Sophia. Today we're tackling a pressing question. Is a major market correction looming, and are stock markets long overdue for a pullback? Over the past decade, we've witnessed an extraordinary bull run in the stock markets. Low interest rates, aggressive monetary policies, and a surge in retail trading have propelled indices to new heights. However, recent developments have sparked concerns about the sustainability of this upward trajectory. Let's delve into the factors contributing to current market volatility and explore how traders can safeguard their portfolios. Understanding market corrections and crashes. First, it's essential to distinguish between a market correction and a market crash. A market correction refers to a decline of at least 10% in stock prices from their recent highs. Corrections are relatively common and can occur over weeks or months, serving as a natural part of market cycles. They help stabilize excessive gains and prevent asset bubbles. On the other hand, a market crash is a more severe and sudden drop, often exceeding 20%, leading to widespread panic among investors. While corrections can be healthy, crashes can have more profound economic implications. Signs that a market correction is overdue. Several indicators suggest that a market correction may be on the horizon. 1. Overvalued stock prices. Valuations in many sectors have reached extreme levels, with price-to-earnings (PE) ratios soaring above historical averages. Companies with little or no earnings are being valued at billions, reminiscent of the dot-com bubble. When valuations exceed sustainable growth rates, a correction often follows. For instance, technology stocks have seen skyrocketing valuations, with some trading at 30 to 50 times their earnings. While this may be justifiable for high-growth companies, the broader market has seen companies that are yet to turn a profit being valued at exorbitant levels. Such overvaluations indicate that investors have grown overly optimistic, making the market susceptible to a sharp correction. 2. Rising interest rates. Central banks worldwide, especially the Federal Reserve, have signaled continued rate hikes to combat inflation. Higher interest rates reduce liquidity in the markets, making borrowing more expensive for companies and consumers. This leads to slower economic growth and reduced corporate earnings, triggering market sell-offs. Historically, when the Federal Reserve embarks on aggressive rate hikes, equities suffer. Higher interest rates increase the cost of capital, making it harder for companies to finance growth. In turn, this leads to lower profit margins and can significantly impact stock valuations. 3. Inflationary pressures. Inflation remains persistently high, eroding purchasing power and increasing costs for businesses. Elevated inflation often prompts central banks to tighten monetary policy, which can result in reduced consumer spending and lower corporate profits. Inflation impacts every sector of the economy, from energy to consumer goods. When inflation rises, consumers spend less, leading to declining revenue for companies. Moreover, companies facing rising raw material and labor costs find it difficult to maintain profit margins, which ultimately reflects in their stock prices. 4. Geopolitical uncertainty. Tensions between major economies, trade wars, and global conflicts contribute to market instability. Investors tend to move their capital into safe haven assets such as gold and government bonds during times of uncertainty, leading to stock market declines. Currently, geopolitical tensions in Eastern Europe, the Middle East, and Asia are causing volatility in the markets. Trade restrictions, supply chain disruptions, and uncertainty surrounding global economic partnerships are all putting pressure on investor confidence. Historically, market downturns have been triggered by geopolitical events such as the oil crisis in the 1970s, the Gulf War, and the 2008 financial crisis, all of which led to prolonged market turbulence. 5. Excessive speculation. From meme stocks to cryptocurrency mania, the past few years have seen speculative investments dominate the financial landscape. When markets become detached from fundamentals, they are more prone to sharp corrections when sentiment shifts. The rise of retail trading and social media-fueled stock movements, such as the GameStop and AMC rallies, highlight the speculative nature of today's markets. While speculation can lead to rapid gains, it often ends in steep declines when the hype fades. Historically, Every speculative bubble has been followed by a significant crash, making it likely that the current market euphoria will meet a similar fate. 6. Economic slowdown. Key economic indicators, such as GDP growth, employment rates, and consumer sentiment, suggest that the global economy may be heading toward a slowdown. A weakening economy often results in reduced corporate earnings and lower stock prices. With global GDP growth slowing and corporate earnings showing signs of stagnation, it is clear that the economy is cooling off. If this trend continues, a recession could trigger a deeper stock market correction. Recent developments amplifying concerns. Recent events have further fueled concerns about a potential market correction. Trade tensions and tariffs. President Trump's threat to impose a 200% tariff on European alcohol imports has escalated trade tensions, leading to financial market instability and increased fears of a recession. The uncertainty affects consumer spending and loan access, adding challenges for the Federal Reserve. Federal Reserve stance. The Federal Reserve's recent decisions have been closely watched by investors. Fed Chair Jerome Powell's moderate stance on inflationary risks from rising trade tariffs and the announcement of a slowdown in the Fed's balance sheet unwind have provided some reassurance. However, the ongoing trade tensions continue to pose challenges. Investor sentiment. Hedge fund pessimism over Wall Street has hit a 5-year high, with funds adopting more bearish positions than bullish ones in March. This shift in sentiment reflects growing concerns about the sustainability of current market valuations. How investors can prepare for a market correction. A looming market correction does not mean that investors should panic. Instead, it is an opportunity to reassess strategies and take a disciplined approach to investing. Here are some key strategies to consider. 1. Diversify your portfolio. A well-diversified portfolio can help mitigate risks during market downturns. Investing across different asset classes such as stocks, bonds, commodities, and real estate can help balance out potential losses. 2. Focus on defensive stocks. Sectors such as healthcare, consumer staples, and utilities tend to perform better during market downturns. These companies provide essential goods and services, making them more resilient to economic downturns. 3. Utilize stop-loss orders. Setting stop-loss orders can help limit potential losses by automatically selling securities when they reach a predetermined price level. This is particularly useful in highly volatile markets. 4. Consider hedging with CFDs. Contracts for different CFDs allow traders to hedge their positions by speculating on falling stock prices. Short selling through CFDs can provide an opportunity to profit from market downturns. Platforms like crystalballmarkets.com offer CFD trading on stocks, allowing investors to manage risks effectively. 5. Reserve cash for strategic purchases. Market corrections offer a prime chance to acquire top-quality stocks at reduced prices. Allocating part of your portfolio to cash ensures you're prepared to capitalize on these market dips. 6. Stay updated and maintain composure. Keeping track of market trends and staying informed about economic changes can empower investors to make smarter decisions. Though downturns can be stressful, history demonstrates that markets generally rebound over time. And that brings us to the end of this episode of Financial Market Insights for Traders. If today's discussion made one thing clear, it's this. While no one can predict the exact timing of a market crash, the warning signs are flashing. Overvaluation, interest rate hikes, inflation pressure, geopolitical tensions, they're all converging. That doesn't mean it's time to panic, but it is time to prepare. So here's your call to action. Review your portfolio. Tighten your risk management. Consider defensive assets. And if you're looking for tools to hedge or trade in either direction of the market, crystalballmarkets.com offers one of the most flexible CFD platforms for retail traders, low spreads, fast execution, and the ability to go long or short on major global indices, stocks, and commodities. Visit crystalballmarkets.com and start trading smarter today. As always, stay disciplined, stay informed, and stay ready. I'm Sophia, and this has been Financial Market Insights for Traders. Catch you in the next episode.